Hello everyone. My name is Sonali Deraniyagala, and it is really my pleasure to welcome you to this third talk and discussion organized by the Women in Media Collective, the Social Scientists Association, and the Feminist Collective for Economic Justice on Sri Lanka's debt crisis, the impending IMF bailout, and what this crisis and the bailout really means for people in this country, particularly those most marginalized and vulnerable. The first of these talks was by Corina Rodriguez, an Argentinian feminist economist who spoke about Argentina's debt crisis in 2001, while also foregrounding some similarities and differences when compared with Sri Lanka. The second talk was by Bhumika Machala. I think she's Indian-Indonesian economist now with the Third World Network, who spoke about the IMF, what an IMF debt restructuring process looks like, and the kind of conditionalities and austerity measures that are likely to follow. Both of them located this crisis as part of a global dynamic and logic of financial capitalism, which makes countries in the global south particularly prone to such crises. Both of them emphasize that this is an economic and a political crisis. Both of them talked about the crisis as gendered and that poor working class women will be forced to bear the greater burden of this crisis. But they also suggested that at moments like this, there is an opportunity for social movements to emerge that can reimagine our political and economic structures in a way that advance equality and justice for all. And I think they both said that when it comes to the conditionalities, that we can and we must negotiate with the IMF to minimize the impact of austerity measures on the most economically vulnerable, and that therefore civil society should actively engage with this process. For those of you who are here who are not there for the two previous talks, an edited transcript of Corina's talk has been posted on Polity, the magazine of the Social Scientists Association, which is now online. And we will do the same with Bhumika's and also with Sonali's. So today I'm really happy to welcome Dr. Sonali Deraniyagala on behalf of WMC, SSA, and the Feminist Collective to continue this conversation with us. Sonali will talk on the economic crisis and options for short-term recovery. As many of you know, she's a brilliant economist. She's currently with the faculty of the Department of Economics at SOAS and a senior research scholar with Columbia University in the US. She has written extensively on international trade, development, macroeconomics, and poverty and conflict. Sonali doesn't really identify as a macroeconomist. She said she's a practicing economist, but one who also knows Sri Lanka really well. So I think she's really ideally suited to explain to us some of the options available, particularly also with the negotiations with the IMF. So over to you, Sonali.
Thanks, Julani, and thanks for asking me to speak. So what I was going to talk to you today, it's very basic, and I'll stick to about 30 to 40 minutes, and then we can open up for discussion. I'm going to talk to you really about the nature of the economic crisis facing Sri Lanka, and we all know a lot about it. So I feel this is just a useful opportunity to summarize and highlight some of the issues relating to the nature of the economic crisis. So I'll talk about the nature of the crisis and about what options we have, mainly in the short term, because we are at a very kind of critical situation right now. And of course, we are facing twin crises, a political crisis and an economic crisis, but my focus here is going to be purely on the economic, but they are, of course, obviously very closely linked. And the word crisis doesn't even really quite capture where we are today. You know, we're in a crisis plus, a very catastrophic situation. So with that in mind, I will kind of outline So what I'm going to do is I will outline some of the key features of this present moment, the present economic crisis. I will look at some of the reasons for this. So some of the historical reasons very briefly, but also the immediate, 3 or 4 immediate reasons. Then I would look at what options we have. And my focus again would be on, because there's been a lot of concern amongst groups like this about what going to the IMF means for the poor, for women, for the less well-off, for the more marginalized segments of society. So I will again look at what does the evidence say on this issue of IMF conditionality and so on. So I'll look at that. Now, as we know in Sri Lanka, we know one of the main themes today has been, of course, that this crisis is affecting everybody. But of course, as with every crisis, this crisis affects everyone, and much more so than many other crises Sri Lanka has faced. But not everyone is affected equally. So my focus also will be to try and draw out, where some groups are going to be affected more unequally than others, more negatively than others. So what is the nature of our economic crisis? And I think there are, at this moment, there are several aspects to it, just at least on the surface level. Yeah? So firstly, we're facing a catastrophic balance of payments crisis, and we all know that. Now, very simply, the balance of payments refers to our account of international trade, any country's account of international trade account. As all countries, we export and we earn foreign exchange, we import and we spend foreign exchange. And there's always a gap in Sri Lanka. We export much less than we import, so we have a deficit on our, what we call the current account of our balance of payments. Now, this has to be fund financed. We need money, the excess money, to pay for our imports. So what we do and have done is, there was a time we did this through foreign aid, and more recently, we've done it through borrowing on international capital markets, through private borrowing. Now, having a current account deficit is not a problem typically, if you can finance it, and if you can afford to make these interest payments on your financing. So, there are essential imports we all need, every country needs. So we need to pay for these imports. And even if they're excess, if there's excess payments, we need to finance it. Yeah, so what I was going to talk today is about 2 things. One is the nature of the economic crisis that's facing Sri Lanka. And 2, to take a critical look at the various options we have, or the very limited range of options we have to deal, or interventions to deal with this crisis, and just to evaluate them and think about how they can be amended or dealt with in order to have the maximum beneficial effect on the population of the country. And the focus being particularly on how is this crisis affecting the less well-off, the poor, how is it affecting women, how is it affecting economically vulnerable groups in society. And of course, we have a twin crisis, a political and an economic crisis, but my focus was going to be on the economic crisis. So what is the nature of our economic crisis? I mean, our economic crisis has, at this moment, several aspects. Very superficially, at least, it has several aspects. Firstly, we have a very severe, a catastrophic balance of payments crisis. Now, we face a balance of payments crisis simply because the value of our imports is much greater than what we earn from exports. And because we can't fill this gap by borrowing on commercial borrowing on international capital markets, or we can't fill it through aid of any sort. At the moment, we've come to this very big kind of bottleneck. So there's been a sudden and very drastic stop in our capacity to import. Now, Sri Lanka, like many other countries, we've always had a current account deficit in our balance of payments, which really means that the earnings from our exports of goods and services has always been less than how much we spend on importing goods and services. Now, this need not always be a problem if we can finance it, if we can get money from somewhere else to pay for it. And typically, when we were a low-income country, we got it through foreign aid. And later, we began to fill it by bilateral loans and by borrowing on international capital markets through issuing what you call ISBs, international sovereign bonds. So right now, what has happened is we can't borrow, we don't have aid, and we can't pay for imports. So that is a balance of payments crisis. Now, yesterday's announcement that we only have $50 million left, usable funds of $50 million left, is very shocking and very chilling. It really basically doesn't even finance one day's imports that this country needs. So the situation is extremely catastrophic. Now, what happens to standards of living, the citizens of a country, when you have a balance of payments crisis of this sort? Several things happen. One is there is scarcity, and that I don't have to explain in the Sri Lankan context. We have extreme scarcity. We have a scarcity of food, we have scarcity of fuel, we have scarcity of medicine, and so on. So the standards of living fall. And for the economically vulnerable, for those who live below the poverty line or just above the poverty line, or those who are less well off, this fall in their standard of living can result in a lot of economic hardship. Secondly, of course, prices go up because there's scarcity. So the prices of, say, the few imported essentials that are the limited stocks that are available, that goes up. And as prices go up, what happens is our real incomes fall. So which means that the money we have, the amount, what we can purchase with the money we have falls. So there's a drastic drop in real incomes. And that we're seeing that too. That's on the consumption side. What happens to production in a country is that we have a lot of essential imports we need to produce, production for investment, and this investment then leads to growth in the medium term, in the long term. So production also falters. Okay, we have less imports of essential things. Even fuel is an essential import, which goes into our production system, all of that. So there'll be a contraction of growth in the medium term. And now as growth falls, also that has a negative effect on the poor, on the less well-off. It can create unemployment, it increases underemployment. It can contract to the informal sector where many of the economically vulnerable are employed. So it can have all of these negative effects from a balance of payments crisis, which are not only short-term. So they're not only today, but this can go on. Then linked to that, of course, Sri Lanka is having a currency crisis, which means that we've had a massive, massive depreciation of the rupee vis-a-vis the US dollar, vis-a-vis other international currencies. Now, this too was, since early March when they stopped, when they floated the rupee, and we've had more than 100%, I think, against the US dollar depreciation over the last 2 years, but really it has happened so quickly since March. So today it stands at about 370 to the dollar, and it was 203 rupees in March. So it's been a wild depreciation. Now that too, that's kind of policy madness as well. And that too has a lot of negative effects, particularly that it's leading to very high inflation. Okay, so the third crisis we are facing is a crisis of inflation. And what is inflation? Inflation basically is a rise in the general level of prices. And we've seen we've seen a huge spike in price levels in Sri Lanka happening again quickly. And that also matters. And so inflation in Sri Lanka, they say, is around 50% right now, year on year. So it's about 50% goods of overall inflation. And food inflation, most importantly, is much, much higher, closer to probably 70%. And as I said before, a lot of this inflation is imported, and some of it is also domestic, which is linked to the agricultural sector failing as a result of the fertilizer policy issue. And I'll come back to that. So what does inflation do then to different segments of society? And basically, when there's inflation, what happens is also that real incomes fall. Okay, so what we can buy with the money we have, the quantity we can purchase falls. And the real earnings of households in real terms falls. And again, when there is very high food inflation, we all know that the poor and the less well-off are much worse affected than those who are better off. Why? Because food constitutes a much larger proportion of their total expenditure for a given month or a given week. And secondly, because for the poor, they have no excess income, they have no savings. So they can't cut back on other types of expenditure to spend on food. So you're stuck with, you have only so much of money, you're spending 90% of it on food. So there isn't room for maneuver here. Now, again, if, in a kind of very neoliberal world, if markets work, you can say that poor households can borrow in order to finance consumption. But in reality, you can't do that because poor households often have no collateral to borrow with. And of course, in the Sri Lankan case right now, we have interest rates, which has been another spike in Sri Lanka. Interest rates have risen to like 25%. So high interest rates, again, completely kind of close down that option of borrowing. You cannot borrow for consumption anyway. The interest rates are very high and so on. So in that sense, again, it has a very kind of strong negative impact on the consumption of the less well-off or poorer households in the short term. Now, this, of course, is extreme hardship in the short term. And in the long term, again, this type of food scarcity or food inflation translates into a lot of negative long-term effects. There's a lot of research that shows that it has children's nutrition, for instance, has a very strong negative impact, or children's malnutrition or lack of adequate nutrition has a strong negative impact on cognitive skills in the longer term, 10 years down the line, 15 years down the line. Now, the deficient cognitive skills or lower than possible cognitive skills, that translates into lower educational attainments, and that could translate into lower productivity and earnings, again, in the long term. So there are a lot of concerns about the long-term effects of this very short-term crisis. There is evidence, say, from sub-Saharan African countries about what scarcity of food and that's not due to inflationary situations, more due to physical scarcity, due to, say, droughts and so on, how scarcity of food affects rationing within the household. An extreme example is in Tanzania, how food scarcity during extreme rainfall, too much rain, and drought led to an increase in what's termed as witch killings, of the killings of elderly women by household members. Why this happened was that, again, the reason for this, after a lot of research, they found one of the reasons was economic. It was a lack of food within the household that turned on. Other killings during that time didn't go up, but killings of women by members of the household went up. And that was the lack of food was one of the reasons that was kind of shown to be underlying this. Again, in terms of food scarcity, there's a lot of research from India, and there's a paper which is titled something like "Why Are Indian Children So Short?" And because it's to do with stunting, and actually stunting in India is greater than stunting in similar countries with similar per capita incomes in sub-Saharan Africa. And again, the reason for that, they found, was male food preference within households in terms of scarcity. So that food then is given to the firstborn male son, and the other children get less food. So there are all these kind of microeconomic effects that happen when these bigger macro issues of inflation, food prices going up, food scarcity arise. So these are again some examples how the effects of these kind of big issues are felt very differentially amongst different segments of society. So the situation in Sri Lanka, therefore, is immediate, but potentially would have very long-term consequences if it's not dealt with correctly. So now, this dire situation, then the issue is, how did we get here? And I'm just focusing again entirely solely on the economic. Yeah? Now, there are many reasons for this, but historically, I would say one of the main reasons for this, how we got to this such a fragile state, is because our economy has had a very lopsided structure historically. And the main fault of our economy is that we have failed to become a competitive exporter. I'm simplifying here a lot, but I think our main issue is that we failed to become a very competitive exporter. We moved from being a low-income country in the late 90s, we became a lower middle-income country. And then we've been stuck there. And one of the reasons for getting stuck in this way is that we didn't develop a strong export sector. And for a country like Sri Lanka, import substitution really is of limited value. Why? Because we have a very small domestic market. So we can't import substitute and build up competitive sectors. You know, we can have a viable agricultural sector that feeds the local economy and so on. But in areas where we need to have high productivity, where we need to grow the economy fast, and in a way that it has a lot of externalities, spillovers, where the positive effects of growth spill over to all sections of society, we need to have big markets is one thing we need to have. And we need to have kind of very correct, smart investment. And what we've lacked is we've lacked this strong export sector. So there's always been a fragility in our economy. And what have we done instead? We've kind of managed, we've always managed, you know, we've kind of managed, we became a remittance economy. So one of our main sources of foreign exchange earnings is remittances of low-waged, unskilled, semi-skilled workers working abroad. We've had a garment export sector, again, which is a bit dependent largely on low wages. We haven't upgraded significantly even within that sector. We haven't moved into producing higher value added apparel and so on. And we've had other products like tea, again, all sectors that depend largely on, so our only competitive edge has been low wages, and we've depended on low wages so we've just had a very narrow focus in our export structure, and we've had a very kind of fragile export structure. And there hasn't been
can
much.
you slow down a bit?
Yeah.
Yeah, for the translators.
Okay, I will. So because we've had this weak export structure, we've had to, since we became a middle-income country, we've been financing it in two ways, because, as I said before, we need foreign exchange that we earn from our exports to buy imports. So to do this, we've had to find foreign exchange somewhere, and we've done it in two ways in the last few decades. We've had bilateral loans, and that is loans given by individual donor countries. And we've had borrowing on international capital markets. Now, bilateral loans typically have low interest rates, compared to when you borrow on international capital markets. You're paying high interest rates, you're paying commercial interest rates. So through these two methods and through this other weak export sector, our economy has just continued. Now, that is the kind of historical reason why we're here, or the more deeper structural reason. And I think it's also useful to look at there are immediate reasons as to why we're in this situation. And in terms of immediate reasons, one is that I can maybe highlight three reasons, immediate reasons. And the first immediate reason is that Sri Lanka's had a lot of wasteful investment, which we have financed through external borrowing. And what type of external borrowing? As I said before, through bilateral borrowing from countries like China, and through commercial borrowing through international sovereign bonds. So again, if you think theoretically about a middle-income country like Sri Lanka, it's not a problem to borrow and invest. That's not an issue. But because the idea is you borrow, you invest in production of various sorts, you could invest in infrastructure. All of this leads to economic growth increasing. Production increases, you export more maybe, production increases, economic growth increases, and that increase in growth then gives the government enough revenue to pay back interest on what we borrowed and to pay back our loans. But of course, we've had a situation in Sri Lanka where we can't do that. So what we've done is we've borrowed and we've spent wastefully on infrastructure that has no return, on highways, on ports. which have had very little impact on our productivity and on our economic growth. So we've had very huge, significant investments, which have not added to economic growth. And that's kind of a very kind of, important factor to remember. And because we've had this lack of growth coming out of investment, we have had a very constrained capacity to pay back. So our capacity to pay back has been very small. And all of this borrowing and investment that have taken place as a result of borrowing has also not changed the anti-export bias of the country. We still are a country which has an anti-export bias, but we've spent a lot of resources and now we've had to pay back this money. So for instance, if you think about in 2021, interest payments, Sri Lanka's interest payments was something like 95% of our total government revenue. Now that is kind of really huge. 95% of what we earned, interest payments amounted to that much. That is interest payments abroad. Now, if you compare a country that borrows similarly or had a similar credit rating on international markets like Ethiopia, Ethiopia's interest payments were about 12% of Ethiopia's total government revenue in the same year. So we have a lot of interest payments and no money to pay it with. So that's one of the immediate reasons, is wasteful investment. The second immediate reason for this situation, I would say, is what economists call corruption, or what we call rent seeking, or the issue of corruption. And there's a lot of interesting work done by economists now on the nature of corruption, on the nature of rent seeking. When is rent seeking a problem? Is all types of rent seeking a problem? Because there's some types of corruption often that we can almost let go as a transaction cost because it'll be too expensive to control certain types of corruption. If an economy has, say, a certain amount of leakage through corruption, but it's also growing at the same time, and it's redistributing that growth fairly well amongst its population, the cost of controlling it in developing countries in particular might be too much. So there are some situations where you would allow, or just kind of leave that, put that on the long finger, leave it to sort out in a few years' time. But the corruption and the rent seeking in Sri Lanka has been very different. It's been really, the scale of it has been enormous. And the scale has become so big that it was unmanageable. And it was also very closely linked to, of course, foreign borrowing, because where did the resources come from? They came from outside the country because there's only a limited number of resources within. And again, and this is just as with wasteful investment, we've had to pay back these resources that leaked out of the economy in terms of rent seeking. So there's a chunk of money or resources, funds would have been taken out of the economy, was not put into investment, which again would have led to growth or reduction in poverty, but just was taken completely out of the economy. But we're still paying back. So again, this is now precipitating our balance of payments crisis. And a third immediate factor that has led to this catastrophe, I would say, is the very, very bad policy choices that have been made. And, now in terms of the government, they talk about mistakes, policy mistakes, but I think it's very important to be clear that these were choices, not mistakes. Those mistakes were not, they didn't do it accidentally, they were choices. And so what are these? We know, what they are. The choice about the fertilizer issue, and there's a lot being said about that. Choice of tax cuts in 2019, which Sri Lanka already had a very low tax base compared to other countries in the world. And over time, that's been mostly decreasing, the tax base, mostly going down. Then it went up a little bit. And then in 2019, there were tax cuts. Now, what do tax cuts do when you cut taxes? It does several things. So there were tax cuts on VAT, tax cuts on income. Now, the first thing tax cuts does is that it reduces government revenue. So on the revenue side, the government has now less money for expenditure. At the same time, if you don't change, you're still, you have very high expenditure. So then this increases your budget deficit. And at the same time, you have to pay payments abroad. So it kind of gives you a double problem, a problem of domestic debt and a problem of external debt. So the tax cuts, in a way, was the kind of last thing we needed. There might have been, some effects on VAT, could have been affected poorer segments of the society in a beneficial way, but the overall effect of our tax cuts was extremely negative for the economy, especially tax cuts on income. So our tax base, for instance, that is the number of people who pay taxes in this country. We have a very small tax base anyway, but the number of people who pay taxes in Sri Lanka fell by around 35% immediately with those 2019 cuts. So now you've had even less of a pool from which to extract taxes. Okay, so that was one big problem. And again, there are political economy reasons underlying, why was these are populist measures, some types of tax cuts, some types of tax cuts on income, on corporate taxes come as a result of lobbying, as a result of connections with, the lack of transparency due to connections between certain segments of private business and government and so on. So there's always a political economy rationale or a political rationale, much more than a strictly economic rationale. And in addition to tax cuts, what have we done in Sri Lanka? Therefore, to finance this gap, we have over, certainly in the last 2-3 years, we've had a lot of printing of money. And, the finance ministry and the central bank were kind of adopting this notion that it doesn't matter, that Sri Lanka can print money as much as it wants, and then it can finance its deficit. And, some of this is linked to this notion of modern, which is called modern monetary theory, which is actually, it's not economics. I'd call it kind of voodoo economics, because it has got no theoretical basis. And when you speak to people or when you read, theorists who talk about modern monetary theory, it changes all the time. It could be anything. So it's a very vague economic notion. There isn't, you can't pin it down. There's no empirical research on it. It's the theoretical assumptions are not spelled out, so you don't know what it is. So there isn't something called modern monetary theory really. But this is what was being proposed in Sri Lanka. So these were choices, choices that were made that kind of brought us to this situation. So that's some of the background. And a lot of this everybody knows anyway. I was just going to highlight it because that then affects how we look at our options. Now, what then? So we are really, we are kind of on a precipice, or maybe we're in the abyss now, and we've fallen into this, unprecedented for Sri Lanka. This is really unprecedented. So what are the options economically? When we talk about options, we have to just focus on, economic options. We need foreign exchange. So what do we do in the short term? Our balance of payments crisis now has become a humanitarian crisis. So what do we do what are the choices there? Because we need somehow to procure essential imports. And without these essential imports, there would be huge humanitarian repercussions. We have no access at the moment to capital markets because we've begun a process of defaulting on our loans. And again, I'll come back to that in a minute. So we have about $50 billion, Sri Lanka has US billion dollars in debt right now. And we've just declared to the world that we can't pay back. We don't have any money to pay back these dollars. So we need to then deal with that issue as well. So what we're doing now is just really relying on few credit lifelines from India and so on to get things like imports. And that's where we're trying to manage with, really on a weekly, we're busking, I feel, we're going week to week, we're busking for money and then managing in that week, but still managing very, very badly. So for this reason now, there are two kind of policy steps that have already been begun and that we should kind of highlight again or just spell out. Again, most people know, but let's spell it out a little bit. And the first step has been to restructure our foreign debt and stop interest payments on debt. So we've done that. We defaulted we had a temporary default on a payment in April, and we said to the world, we can't pay our foreign debt back. And together with it, the second step we took is to go to the IMF to borrow through really what's called extended fund facility, or EFF. So we've gone to that IMF to borrow through this extended fund. There was some talk of borrowing through rapid financing, but that's very unlikely as an instrument. See, the IMF gives loans on different types of loans. And one is called the rapid financing instrument. And the rapid financing instrument is very specifically for countries that have a one-off crisis, like COVID crisis. It could be a natural disaster. It could be like the small island states in the Caribbean faced with sudden, hurricane. That would be, those countries typically qualify for a rapid financing instrument. And that instrument usually is not linked to any conditions. It's just given very quickly too, so the country can stabilize. In Sri Lanka's case, it's most likely to be a EFF, which is a more longer term borrowing. Yeah, we're borrowing the foreign exchange we need for a longer period. Now, what will this EFF do in the immediate term? It'll, of course, ease our foreign exchange constraint. So that's very... Now, both the debt restructuring and the IMF borrowing, they're interlinked, right? One, you can't really have in this world one without the other. And they're both a process. They're not going to happen overnight, and they're a process. So we must also kind of bear that in mind. Now, before we get agreed, before the IMF agrees to an extended fund loan or any type of loan, their condition for us would be that we need to restructure our debt. And so Sri Lanka is now just about to begin, I think, and I don't know how far we've got. We're going to appoint lawyers and so on to restructure debt. Now, what does debt restructuring involve? It involves really talking to all the people we owe money to our creditors. Okay, they could be individual countries, like it could be China, Japan, it could be multilateral institutions, the ADB, the World Bank. It would also be all up, most importantly, private creditors, people who bought Sri Lankan bonds. It could be, funds, various kinds of pension funds, and so on. So you have all this range of creditors, and you need to get an agreement amongst all the creditors saying, okay, we agree that you can't pay us back, and we are willing to accept either lower rates of interest on what you owe us, B, a lower total, a lesser total amount. You see the word haircut, so this is what it refers to. Haircut refers to either taking less interest or taking, less in terms of the capital. So you have to agree on this, and this can be, quite a long process. There's back and forth. Sri Lanka would then give certain proposals. Typically, the creditors look at it and refuse those proposals. Then, it goes back and forth, and there has to be some agreement. So time is one problem. The other problem with restructuring, and that's risen kind of in many countries recently, is that it's quite hard to get a full understanding of how much debt. We say $50 billion, but sometimes, this amount can also change when you really look into the books and see how much debt Sri Lanka has. Especially, and there's been an issue with bilateral lending from China, and a lot of this, there's a problem about, there's a lot of areas where it's not very clear in terms of exact numbers and how much it has. Zambia had this problem because Zambia was just ahead of us in restructuring. They went to, Zambia defaulted, went for a debt restructure, and is right now engaged in that. And the Chinese Chinese loans from Zambia, lending to Zambia, when they did finally, when they did all the research, they found was actually double. Zambia owed China double, or much more than was originally assumed to. So there's this big, you have to really, because none of the creditors want to agree to a restructure until they have a real clear idea as to how much each creditor is going to get. So there's all these issues that will arise. So the IMF, before lending, needs a debt restructure, but the debt restructuring, or the creditors also, typically in this world, needs assurance that Sri Lanka is engaged in talks with the IMF. If they're going to agree to a restructuring and to agree to various haircuts, they want the assurance that Sri Lanka is also going to enter a program with the IMF. Why? Because they want to know that the Sri Lankan economy will be stabilized by the IMF in a way that allows Sri Lanka to pay back the debt, even at these lower rates of interest and lower capital amounts and so on. So this, double thing will go on for a while. It's not very short term. Then there are various technical aspects to this process. When the IMF, before engaging into an extended fund or any kind of loan agreement, the Sri Lankan side, as well as the IMF, has to come up with what you call a debt sustainability analysis. That is, it has to kind of make various forecasts for the economy on various, what happens if the economy grows at 2% or -1% or 5% with an IMF loan. And then to see whether these forecasts, how much would the government be spending during this, these various forecasts, to see whether the path of growth is going to be stable enough in order to allow these debt repayments. Okay, put simply, that's what a sustainability analysis is. That is the growth path, is the path of public finances going to be sustainable enough to allow us to pay back these debt repayments. There's been, and the IMF has also rethought of the way it does its debt sustainability analysis, like last year even. And there have been some critics of this, like the Bretton Woods Project, who's an institution or research think tank that's been very critical of the IMF, and who've looked at this debt sustainability and asked whether it tends to favor creditors more than it favors citizens of a country. And that's an important issue to think about as well. I'm not sure actually about that. That I think depends, but it's something worth thinking about, and I'll come back to that. So given that, Sri Lanka has kind of begun this process of IMF seeking a loan from the IMF, I think it's kind of useful for us to look at, and there is a lot of concern about what are the problems with, the benefits in the immediate sense, the kind of obvious, we'll have foreign exchange. Are there issues to deal with, IMF lending and borrowing and so on? So I'll now kind of turn to look at that. Now, typically, in terms of IMF lending, what is the aim of IMF lending? Typically, it is to stabilize the economy. What the IMF wants to do. And what do we mean by stabilize the economy? It means really not having extremely high inflation. It's not having balance of payments crises like we have. It's not having exchange rate crises like we're experiencing right now. So it is to have a very stable path for the economy. It's to get over situations like ours. It's to smooth this present situation. And to do that, the original stated two tools of the IMF were two, like mainly fiscal policy, which is spending and borrowing of the government, and fiscal policy and monetary policy. That is how the central bank prints money or raises interest rates. So there are two types of policies that the IMF was seen to be, it was seen as okay for the IMF to have some influence on or to advise on these two areas. And so a lot of the lending that the IMF began to do, say in the 1980s, we went into the 1990s and then 2000s and so on, a lot of the aim of IMF lending was called stabilization. And this was different from the World Bank that gave money and for what was called structural adjustment. Now, all of that has changed for the bank as well. But early lending from the World Bank, say from the late 80s, 90s, even into some of the 2000s, was really referred to as adjustment. And the IMF was supposed to deal with stabilization. The World Bank was supposed to deal with adjustment. Now, there have been a lot of criticism of IMF stabilization policies, particularly from the 1990s through to the kind of mid-2000s and even after. And what are these? It's useful for us, therefore, to kind of see what are these critiques, if we are to kind of think about whether they will apply or apply at all in a Sri Lankan context. One of the main critiques, of course, has been to do with IMF, what is called conditionality. That is, conditionality has referred to or refers to the policy impositions or the policy requests that the IMF asked borrowing countries to implement. So it was like, okay, you need a loan for $50 billion over that many years. And in order to get this loan, country A must, undertake these types of policies. And so there was a prescription of policies. There was a list of policies of the IMF and the World Bank almost together insisted that many countries implement it. So these were conditions of getting the money. So conditionalities, they were called conditionalities. The original, going back historically, the original reason for these conditionalities was that the IMF had a very, relatively small pool of money to lend to the world, and the number of lenders grew over time. Now, it had what you call a revolving door, as in, so I borrow, then I return, and then the IMF takes that money and lends it out to someone else. So to have this revolving door open, the argument was that you needed some conditions to make sure countries can pay back, that the money they borrow is not wasted. So that was way back, and this was in the 50s and so on. That was the kind of history of conditions and conditionality. But really, since the 1980s, the argument has been that conditionality of the IMF has been really kind of ideological and coming from one side of economics, from one school of economic thought, and so on. And so therefore, there's been a lot of criticism of these conditionalities. And what are these criticisms? Let's do very briefly, what are the main ones? So the main criticism of conditionality has been that of controlling the public, of the importance of countries to be fiscally conservative, which means that the countries should control their public debt or their fiscal deficit, which is the gap between what you spend, what the government spends, and the revenue it earns. Okay, so the IMF has, as one of their main conditionalities was that countries that borrow should try and move to, or should move to, having a fiscal surplus, which means that these countries should earn more than they spend. Okay, and what do countries spend on? What does the government spend on? They spend on things like investment, on welfare, on sectors like health, on various social sectors, education, and so on. So these expenditures should be in line with what you earn. And ideally, you should have a small or some kind of surplus on for the economy to be stable. You should have a surplus on your fiscal deficit. So this conditionality of deficit, and this is what's called austerity typically. And so this conditionality of imposing austerity has been come up with a lot of criticism. Now, why have they, what's wrong with austerity? If you want to go back to basics, we can ask, so why, what have been the critiques of it? One is that this particular conditionality of austerity and conditionalities of the IMF in general, one is that they have failed to promote economic growth, that there's been a lot of intensive empirical research, which has looked at IMF programs and taken, big data sets with a lot of programs in them and looked at them. And what they've shown is that on average, countries that have taken IMF lending have most often have recorded IMF lending, has been linked to a fall in economic growth rather than an improvement in economic growth in the short term. Okay, so that's been one critique, that IMF lending has not been beneficial to growth in an immediate sense. And why is that? And the argument is that the IMF lending has been linked to a fall in productive investment by the government, by the borrowing government, because of the pressure to keep your fiscal deficit in check. And so that's been one area of criticism. On the long run, however, the evidence is more kind of murky or more vague, or not vague, inconclusive. And in the long run, the evidence is that there could be, in some borrowing countries, there could have been an increase in economic growth on average in the long run. So that's been one set of issues. Another issue that's raised by economists like Robert Barrow has been that lending in IMF lending sometimes has been linked with countries becoming less democratic. Again, why is that? We can ask, and the reasons they give is that IMF lending has also been linked to resources being captured by elites. And this resource capture, therefore, average incomes haven't gone up, but national income has gone up. And this resource capture has concentrated economic power, and this economic concentrated power has been able to influence politics. So therefore, countries have become less democratic. A third criticism of the IMF conditionality is that they've had a negative, these conditionalities have a disproportionately, and that's an important word, disproportionately negative impact on the poor as opposed to other segments of society, the better off. And again, there are many reasons for this. Why is that? One could be cuts in subsidies would obviously, if it's things like welfare payments, though typically, lots of programs have not been associated with welfare payments, but reduced subsidies could be even on things like fertilizer and so on, would have a negative impact on the poor by raising prices. If there's unemployment as a result of controlling the fiscal deficit, again, it's more likely to impact on the poor in a negative way. Increases in VAT has a negative impact on the poor, and so on. So these are possible ways that the poverty can be affected. But what does the research tell us? If you look at, what does this, again, this is a huge body of empirical research on IMF lending and poverty. What does the research tell us? That the reality is a little bit more complicated. It's complicated. I think, looking at everything to summarize what the research, it would be that what it shows is that when IMF lending is accompanied by economic contraction, the poor suffer less than when there's economic contraction without IMF lending, if you see what I mean. So if IMF lending happens and there is a contraction, there's some kind of protection for the poor. If in situations where IMF lending is accompanied by economic growth, quick economic growth, the poor benefit less from that growth. So that has been the kind of, the more nuanced picture that emerges in relation to, and we can talk about this a little bit more in the discussion, lending and poverty. So it smooths consumption and so on for the poor in situations of contracting economies. But it could be in expanding economies, it could be that the poor don't benefit so much. And that is, again, something to be thought about. And it could be that why do the poor benefit less in situations of economic growth and expansion? It could be that most of the poor or the less well-off segments of the population, they work in the informal sector. And the informal sector might not be the sector that grows during IMF-led investment growth period. So it could be the difference between a formal sector of the economy and the informal sector of the economy. And this, again, in terms of, how we think about where Sri Lanka goes forward, the issue of the informal sector, again, has to be taken into account a lot, I'd say. Now, so those are some of the critiques that have been leveled at IMF conditionality over time. And these I'm talking about the academic economic critiques. And then to counter that, there's also evidence that, in the last decade or so, even within the IMF, there's been a lot of self-reflection. And there's been again, academic papers coming out of the IMF evaluations of their policies and their lending over periods of time, long periods of time, which has argued that fiscal conservatism of the IMF has not been beneficial. That is, these conditionalities in terms of fiscal deficits should be loosened, has been the general kind of theme of that research as well. That this has not a good effect on growth, and not a very good effect on poverty. So, for instance, people like Oliver Blanchard, who was chief economist in 2010, said that countries should not have a fiscal noose, and that's what the word used. Christine Lagarde even say that there's no need to brutally slash economics when economies are in recessionary situations, you mustn't brutally slash expenditure and so on. So on the one hand, so there is some awareness, and there's some. On the other hand, there was, issues like the recent Greece debt crisis, where both, the Troika, which was the IMF, the European Union, and the European Central Bank, imposed very harsh austerity on Greece And even there, which Yanis Varoufakis, he calls it fiscal waterboarding. But even amongst the three, I mean, I think even he would agree the IMF was the least waterboarder. He was the least, it was kind of more willing to allow state expenditure compared to the other two, the European Union and the ECB. So given this, kind of track record, if you like, of the IMF, the question is about Sri Lanka. What are we looking at going forward? And so there's a lot of concern, especially amongst forums like ours here today, that the IMF borrowing would lead to austerity. So all of this is really, I was trying to address that issue. And so will it? And the question, we have to ask, so to answer that question, the first thing we have to note is, today we are in a situation of extreme austerity. Okay, where we are now is a situation of very extreme austerity. So starting from here, I think there's only two questions. We have extreme austerity and we need foreign exchange. So starting from here, there's just two questions we need to ask if we are concerned about poverty, if you're concerned about the standards of living for those marginalized citizens or the economically less well-off, which is really a large segment of society today. So the question is that we have to ask is that two questions. One is that will austerity and poverty increase more with taking, whilst taking an IMF loan, or will poverty or austerity increase if we don't, and we have no choice, if we do not take an IMF loan? And that is really, the issue, it all hinges on that. And, I think, in this immediate sense, very likely it's a second scenario. If you don't go into, borrowing from the IMF, you're going to see a very, drastic increase. So we have no choice. And, so that is where we're at. And that's the kind of question we have to pose. And then from that, we have to see that, okay, so how do we deal with that? And as you said, Chud, and even the previous speakers, they talked about the scope for bringing in these issues of inclusivity, of protecting the vulnerable, and so on into when we talk to the, these multilateral donors now. And there is scope, and that's what I would say. And I'd say, there's scope for many reasons. One would be that the IMF itself has changed its. Okay, am I back? Yes. That the IMF itself has changed its mind, has had some self-reflection and is less stringent on this type of fiscal conditionality to some extent. Secondly, there is the issue of, especially in the post-COVID, or during the last couple of years, there's been a lot of expansionary fiscal policy, which means that governments have spent and spent and spent faced with a huge crisis, especially advanced economies. How do they cope with COVID? They spent a lot of money. So this argument that spending is very bad for the economy, obviously now has, and from all, in America, for instance, both, from the Republican, it was the Republican regime, government, that administration that, embarked on this huge spending. So that spending, the notion that spending is a bad thing is kind of now, it's much harder to claim that today. And thirdly, we also have, countries like Argentina very recently, when they renegotiate or restructured their IMF, the big IMF loan that Argentina got a big loan in 2018 of, 60 billion or something, huge IMF loan. And they took that loan, and it was a very political kind of why they got so much money, apparent. And then, Argentina, of course, couldn't pay back. This is to the IMF, couldn't pay. So Argentina just restructured it. And that restructuring, the interesting thing about this very recent, in February, March of this, or maybe April even of this year, the interesting point was that restructuring was not linked to fiscal reining in or into controlling the fiscal deficit or austerity. Argentina, in fact, has a quite an expansionary fiscal policy. It's spending its way out of a recession in a kind of pro-growth way. And Argentina was allowed to do this. So a gradual moving out of fiscal public controlling the public, that it's gradual controlling the public sector deficit. So there are reasons, for us to there are precedents almost to say, look, so Sri Lanka we are in a very, very kind of catastrophic state. We need to, we need relief, but that relief shouldn't make our situation, shouldn't have negative impacts on A, the autonomy with which to conduct fiscal policy, and B, in terms of how fiscal policy affects the more vulnerable. So there is scope for, cash transfers, but not only just to, like in Sri Lanka, not only to some of the recipients, but to a much wider segment of society, cash transfers. If there is, if subsidies are reformed in Sri Lanka, and, to some extent they have to be, or to a large extent, then for subsidies in particular, again, how do you protect the vulnerable and so on. There's I think a lot of scope for bringing gender very kind of centrally into this analysis. The IMF assessment, of March this year also talked about, one of the main things they talked about was female labor force participation, and Sri Lanka needs to increase female labor force participation, and that's something again to do. So there are these options that can be done, and then there are other things we can think about even going forward in terms of debt in the future, like debt, green financing of debt, and there's something that we haven't begun to look at, and I think it's not in this crisis we can't do it, but so there's a little bit of room for, I think, progressive kind of interventions at this stage, given how catastrophic it is.